Right, our next speaker is Dr. Julian Jacks, another member of Michael's list. Julianne has a very eminent background in both taxation and the law. She has been a member of the Victorian Bar since 2002. Prior to that, she practiced as an accountant with Coopers and Lybrand. She spent 5 years in the tax division there and has advised extensively in all areas of revenue law, including income tax, GST and state revenue matters. She had a stint working as a couple of years as the Senior Taxation Advisor for the Federal Assistant Treasurer, the Honourable Rod Kemp, who was 2IC to Peter Costello in the Howard government when in Treasury. Julianne's going to talk to us about Division 7A and all of the thorny aspects of Division 7A, including some background matters and the more recent tax ruling that morphed from its draft status in November of last year to becoming an official ruling on the 30th of July this year, and which has attracted quite a bit of publicity and to some extent thrown the cat amongst the pigeons. So if you could all welcome Julianne to talk to us about Division 7A.
This morning I'm going to turn things around a little bit at the start because I'm going to start with the conclusion. I'm going to start with the important bit that you need to take home with you or back to the office with you this morning when we finish. The reason I'm doing this is that way you'll know what you need to know, even if the coffee wasn't strong enough and you do tend to drift off in the middle of what I'm going to say, which of course is incredibly unlikely because I'm going to be talking about tax. And there's nothing more exciting. What you should take away with you this morning is this. If as part of a property division your client is receiving any benefit from a private company, it's probably going to be deemed to be a dividend and so taxed as a dividend. And if the benefit comes from a family trust, then it might be deemed to be a dividend, depending on the relationship that trust has with a private company. So what do I mean by a benefit in this context? I mean a private company making a payment to a spouse, or transferring property to a spouse, or letting a spouse use property belonging to the company, or making a loan to a spouse, or even forgiving a loan owing by a spouse to a company. Hence Peter flagging the issue where there's a whole lot of inter-entity loans, including a loan from the husband to the company. If the company forgives that loan, it's probably going to be a dividend under Division 7A. Now, the same benefits coming from a family trust are also likely to be deemed dividends, where the private company has what's called an unpaid present entitlement to the trust's income. And if I've lost you at that point, don't worry, because I'm going to explain what an unpaid present entitlement is. The provisions that deem these benefits to be dividends are contained in Division 7A of the Income Tax Assessment Act 1936. Now, previously, the Commissioner said Division 7A didn't always apply to the splitting of marital assets. But in Tax Ruling Number 5 of 2014, he's changed his mind. That's the one that was issued on the 30th of July this year. So really the bottom line is, if there are transactions involving companies or trusts, then warning bells should start to ring. And that's the crux of what you should take away with you today. What I'm going to do over the next half an hour is explain to you why this happens and how it happens. That is, how Division 7A works. My reason for doing this is that hopefully you'll then be able to see the warning signs more clearly. And I'll also explain a couple of further points that it would be good for you to take away with you today, but they require a little bit more explanation. Now, to understand Division 7A, it's necessary first to understand and remember that different entities are taxed at different rates. I know this is going right back to basics, but if you have this in your mind when we're talking about Division 7A, then it's more easy to actually understand what it's trying to do. Now, as we know, individuals, people, are taxed at marginal rates. The more they earn, the higher tax rate they're going to pay. And at the moment in Australia, the highest tax rate is 45%. Add to that the Medicare levy, so effectively the highest tax rate is 47%. Companies pay a flat rate of tax, 30%, whether their taxable income is $1 or $1 million, they'll be paying tax at 30%. Now, the tax on trusts varies. If we're talking about trusts with Australian resident beneficiaries, which is what I'm talking about today, they don't have to pay any tax if they make beneficiaries what's called presently entitled to all of their income. Now, how a trust makes a beneficiary presently entitled depends on the trust deed, but normally if we're talking about a discretionary trust, the trustee makes a declaration declaring which beneficiaries are presently entitled to what proportion of the income. A trust doesn't actually have to pay a present entitlement to the beneficiary, but the beneficiary will be taxed on the amount of their present entitlement from the trust. If the trust declares a beneficiary to be presently entitled to income, but then doesn't actually pay it across, retains it in the trust for investment purposes, for example, then the beneficiary has what's called an unpaid present entitlement in the trust. It's a bit like a loan, a little bit like a loan that the trust owes to the beneficiary. Now, a trust has a bit of an incentive to make beneficiaries presently entitled to all of its net income, its taxable income, because if no beneficiary is presently entitled to the income of the trust, then the trust is going to be taxed at a flat rate of 45%. A flat rate of 45%, and it doesn't get much higher than that. There are a few exceptions to this in trusts. For example, the trust of a deceased estate less than 3 years after the deceased died, the Commissioner concessionally taxes that at individual marginal tax rates as though it's a person, which is a great tax planning mechanism, but the problem is you have to die to get it. So people don't tend to plan for that one. Now, once you understand the way that these different entities are taxed, what you'll understand is a fairly vanilla family business structure. And this is it. This is a fairly vanilla family business or investment structure. Now, I should note at this point that I'll be talking about this structure as though it's all done for tax reasons. There are other reasons to use companies and trusts, such as asset protection, such as flexibility in distributing income, but just for ease of reference, I'll be talking about the tax implications and the tax benefits of it. Now, in this structure, the business or the investments will be in the discretionary trust. That's the box down the bottom. The beneficiaries of the discretionary trust are the two boxes above. It's the family members and also a company, which is then owned by the family members. The discretionary trust distributes its income to the family members, but only up until their taxable income reaches a level where they're paying tax at a rate of 30% or above. Then what the discretionary trust does is it makes the rest of the income, it makes the company presently entitled to the rest of the income. What that means is that the maximum rate of tax paid is 30%. Now, I'm simplifying this somewhat, but that's the very broad principle of this basic business structure. And that's where the aim is that the tax stops at 30%, because anything in excess of that they're going to pay to the company, it won't pay any more than 30%. There could be permutations and combinations to this structure. For example, the discretionary trust might actually own shares in another company and the business might be carried on in the company below, and then the company below pays dividends to the discretionary trust, which then distributes it to its beneficiaries. But this is just a very, very basic structure. The problem is the family might actually need more money than it's been made presently entitled to. So then the question becomes, how do they actually get the money out of this structure? Effectively, how do they get the money out of the company without paying more tax than 30%? And that has always been the challenge, and that's where we get Division 7A from. Now, the problem, they can always pay dividends. That's the easiest way to get money out of a company. But the problem with dividends is that they're going to be taxed. And because it's relevant to understanding the new tax ruling, I'm actually going to explain and go to the provisions under which a dividend is taxed. First, we have to look at the definition of a dividend. And this is contained in Section 6, subsection 1 of the Income Tax Assessment Act 36. This is actually on page 1 of the handout. If you want to look at your papers, it might assist a little bit. If you have a look at my paper, which is headed Division 7A and Taxation Ruling TR 2014/5, go to page 1 of that. And you'll see there the definition of a dividend in section 6.1. Have a look in particular at paragraph A. And what it says is a dividend includes any distribution made by a company to any of its shareholders, whether in money or other property. So there are three things to notice there. First of all, the dividend must be a distribution. Secondly, it must be paid to shareholders. And secondly, it must be money or other property. Just remember those three things. Over the page, you don't have to look at it now, is section 44, which includes a dividend in assessable income where it's paid out of profits of the company. One advantage of a dividend is that it can be franked. Now I'm sure you all know what franking means. I'm not going to go through these numbers. You'll see up on the screen an example of what franking means. It means effectively if the company makes taxable income of $100, pays tax at 30% on that, pays a dividend of $70, the individual puts in their tax return $100 taxable income, gets a credit for $30, and then only has to pay, if you like, the top-up tax of $17. It means that by the time it reaches the individual, 47% or the marginal tax rate is paid, but nothing in excess of that. 30% of it's paid by the company, 17% by the individual. And if excess franking credits are going to be refunded if the individual is on less than 30% tax rate. That's the basic way a dividend is paid. But what tax planners have been trying to do for years is to get the money out of the company without having to pay that top-up tax, that extra 17%. So if you just think it through, how can you get money out of a company without worrying about tax implications, apart from paying a dividend? Just give money or property to an associate of the shareholder. As you saw in the definition of dividend in section 6.1, it has to be paid to a shareholder. If it's not a dividend. Easy, pay it to an associate. Make a loan to a shareholder or an associate instead of a distribution. It's not a distribution, it's not a dividend, it's not assessable under the normal provisions. If the shareholder or associate owes money to the company, just forgive that debt. It's not a distribution, so it also is not going to be a dividend as defined under the normal provisions. All sounds very straightforward. There's a rather more circuitous route. If you just take your mind back to that structure that I showed you earlier, as I said, sometimes a trust will make a company presently entitled to its income but not actually pay that income over to the company. So the company kind of has a loan to the trust. Well, the circuitous route to get money out of the company is not make the distribution to the company and instead make a payment or make a loan or forgive a debt from the trust to the shareholder or the shareholder's associate. It's a bit more of a circuitous route. That's why I say it's relevant, or I said earlier, Division 7A can apply where there's an unpaid present entitlement by a company owing to the trust. But I'll come to that when I talk about Division 7A, which is what I'm about to do. The aim of Division 7A is to deem all of those ways of getting money out of a company that I just described to you to be a dividend. What it deems to be a dividend is, first, payments to shareholders or their associates are deemed to be dividends. Now, if it's a payment to a shareholder, it will be a dividend in the first place, so Division 7A doesn't need to apply, and indeed Division 7A will not apply if it's a dividend under normal provisions. But if it's a payment to an associate, it's not a dividend under normal provisions. Division 7A will deem it to be a dividend. Now, a payment under Division 7A doesn't just mean a payment of money, it means a transfer of property. It even means making an asset available for the use of the shareholder or their associates. So if the company owns a home and the shareholder or their associates live in the family home, then there is a deemed dividend in there. But payments on commercial terms shouldn't be caught. This is covered by section 109 capital J, and I'll be coming back to that section because that's the one that's particularly relevant to the tax ruling that's issued. Secondly, the second category of things that Division 7A deems to be a dividend is loans to shareholders or their associates, unless they're at arm's length, on arm's length terms, in which case they won't be a dividend. Thirdly, debts which are owed by a shareholder or its associate to the company which are forgiven are deemed to be dividends as well. And this is going to include debt parking, where the debt is assigned to another entity that will not force repayment. And finally, if the company, as I said earlier, has this unpaid present entitlement, which is a bit like a loan to the trust, then Division 7A deems all the loans, debts forgiven, and also certain payments and property transferred by the trust to the shareholder or its associate to be a dividend. They'll also be deemed dividends if the payments or loans are through an interposed entity. This includes back-to-back arrangements. For example, if a company deposits funds with a third party and then that third party then lends those funds to a shareholder of the company, and I'm talking about non-commercial rates here, then there'll be a deemed dividend under Division 7A. So really what the government's tried to do is just cover every example they can think of where someone might try to get money out of a company without it being a dividend, without having to pay that top-up tax of 17%. There are a few other points to be aware of when we're looking at Division 7A. First is that the amount of the dividend is limited to the company's distributable surplus. That's intended to ensure that Division 7A dividends are only going to be assessable to the extent that they're paid out of the profits of the company, which is similar to the way that dividends are taxed under Section 44. The second point to be aware of is that there's no deemed dividend if a payment or loan is made to another private company. So if a family has two private companies, it might be possible for one spouse to take one company, the other spouse to take the other company, and the property contained in the companies to be distributed between them. And that makes sense without looking at other tax implications. And that makes sense. The money's still trapped in the company structure, so there's going to be no penalty because it hasn't actually been taken out of the company structure. Now, the final point has to do with franking. Normally, Division 7A dividends can't be franked. This is a little bit of a punishment for doing something that causes a deemed dividend. But there's one exception. If what's done is done to discharge a, quote, family law obligation, then it can be franked. Now, this is contained in Section 109RC, which is reproduced on page 4 of your handout. I'm not going to take you to that now. Just trust me, that's what it says. What I am going to take you to, however, is the definition of a family law obligation. That is, what has to occur in order to permit one of these deemed dividends to be franked. And that's on page 5 of your handout. Now, have a look down the bottom of the page and you'll see the definition of family law obligation for the purposes of Division 7A. It refers to an order, an agreement or an award mentioned in paragraph 126-5 of the Tax Act 1997. The government decided to do a very clever thing in 1997. They decided to rewrite the tax legislation in plain English. So now, instead of just having one act we need to work with, we've got two acts, and we've got decisions which relate to the old 1936 Act and the new Act which relates to 1997, and we have to make sure that if we're looking at old decisions, the new legislation that's been rewritten still has the same meaning. The idea was simplification. Anyway, that's why I'm referring to a 36 Act and a 97 Act. Now, Section 126-5 in the Tax Act 1997 is the provision that deals with the capital gains tax rollover relief for marriage breakdowns. Now, if you look at the definition of family law obligation on page 5, it refers to paragraphs A, B, D, E or F of Section 126-5. Now turn over the page to page 6 and you can see Section 126-5, and there you can see that there is a paragraph A, a paragraph B, a paragraph C which is empty, so we don't worry about the fact that it's missing from a family law obligation definition, D, E and F. But you can also see that there's a paragraph DA. Paragraph DA deals with Part 8AB financial arrangements, and they're, as I'm sure you all know, are concerned with de facto relationships. So that's just another little point to take away with you this morning. What you should be aware of is that the law as it currently stands, if there's going to be a deemed dividend that arises because of a financial arrangement between parties in a de facto relationship, then it's not going to be frankable. And if you want it to be frankable, then obtain a court order so that it's going to be covered by paragraph A in that list in section 126-5. Now, it might just be an oversight in the legislation because paragraph DA was introduced after the relevant provision and the definition of family law obligation, but whether it's an omission and oversight or not, it happened quite a few years ago, it's still there. So that's just one quirk to be aware of where the financial arrangement for de facto couples is not treated exactly the same under Division 7A. Now what I've done is explain to you what Division 7A does, how it works. What I'm now going to do is just put it all together in order to explain Tax Ruling Number 5 of 2014. If you recall, I said earlier that a payment to a shareholder or associate that's on commercial terms is not intended to be caught by Division 7A, and it makes sense because a shareholder or associate should still be able to, for example, provide goods or services to a company and be paid for those goods or services. And as long as that's what's happening, everything's fine and there's going to be no Division 7A dividend on the payment to that shareholder for those goods or services. And the section that achieves that is section 109, capital J. So let's have a look at that now. You can either look up on the screen or it's also on page 3 of your handout. Just have a quick read through of that. The question is, what about a court order under section 79 of the Family Law Act for the company to pay an amount to a spouse or distribute property to a spouse? If it falls within that exception, then there's not going to be a Division 7A dividend. The question is, does it actually do that? Previously, the Australian Tax Office took the view that there were some circumstances in which section 109 capital J would apply to orders under section 79 of the Family Law Act. First, the order had to be imposed on the private company, not on the spouse. Because you can see, actually I'll go back to it, you can see that under paragraph A, the obligation must be an obligation of the private company. So if it were an order requiring one of the spouses to cause the payment to be made, and the payment was made by the private company, then it would not fit within the exemption in 109J. Second, the ATO said the order has to be to pay money. That's also in paragraph A, a distribution of property wouldn't fall within that exception. And third, the payment could be made to either the shareholder or the associate. The Tax Office took the view that paragraph B would be satisfied in these circumstances on the basis that if a court makes an order, then the payment is just necessarily going to be an arm's length payment. They've changed their mind, but we'll come to that. The Tax Office also took the view that this payment wouldn't be a dividend as defined in section 6.1 because it was a payment made pursuant to court proceedings is not in the nature of being a distribution, whatever that means. And if you remember going back to the definition of dividend in section 6.1, it requires it be a distribution. That summarises that. As you can see, the Tax Office took the view that 109J, the exception in 109J, would apply and there'd be no deemed dividend if, under section 79 of the Family Law Act, the court orders a private company, not a spouse, to pay money, not property, to a shareholder or associate. Seems somewhat arbitrary. Perhaps the ATO thought so too. In any event, they've now changed their mind. On the 13th of November last year, the Tax Office issued draft ruling number 6 of 2013, and that turned all of that on its head. And on the 30th of July this year, Tax Ruling Number 5 confirmed that draft ruling. So what does Tax Ruling Number 5 of 2014 say? Quite simply, if a court makes an order under Section 79 of the FLA for a company to pay money or property to a shareholder, then it will be a dividend under Section 44. It doesn't matter whether or not the company is a party to the matrimonial proceedings and the order is against the company, or the order is against one spouse to cause the company to make the payment. The ATO now takes the view that a payment under Section 79 order will be a distribution and so meet the definition of a dividend. So that's the first way in which they've changed their mind. So if the payment's going to the shareholder, bang, dividend, deemed dividend. What about payments property to associates? The ATO now takes the view that these will be deemed dividends as well. Where they've changed is they've changed their view that a payment pursuant to a Section 79 order will be an arm's length payment. So what they're now saying is that paragraph B is not going to be satisfied. The ATO now thinks that an amount paid under a Section 79 order will by its very nature be more than would have been required to discharge the obligation had the private company and the recipient been dealing with each other at arm's length. And that view is really summed up in paragraph 113 of the tax ruling. If you want to have a look at that, it's on page 29 of the handout. Sorry, 22. And as it says there, in view of the foregoing, the Commissioner considers there is no identifiable circumstance under which a private company might make a gratuitous appropriation of profits to a non-shareholder in discharge of an obligation in an arm's length dealing as required by the test in paragraph 109JB of the Income Tax Assessment Act 1936. Now this change is going to apply to Section 79 orders made on and after the 30th of July 2014. So once again, as I said at the start, if there is payment or property coming out of a company, and sometimes if there's payment or property coming out of a trust, it's probably going to be a deemed dividend under Division 7A. Now, just while you're looking at tax ruling number 5 of 2014, I'd like to take you to another interesting little paragraph there. It's concerned with the CGT rollover. It's outside my brief for this morning, but it's something I think you should be aware of and I found quite interesting. Have a look at paragraph 136, which hopefully is on page 25, but there are no guarantees. At this stage, I'd just ignore the first sentence, which just reads like a bit of gobbledygook referring to all the provisions, but have a look at the example in the second paragraph. So what that's saying is that if you want a CGT rollover to apply on a distribution of property from a company, make sure that the Section 79 order specifically refers to the property being transferred and not just to a payment being made with the parties agreeing later on to effect that payment by way of a property distribution. Lastly, just a couple of points about the nature of a tax ruling and the authority of a tax ruling. A tax ruling is not the law. It's the Commissioner's opinion on how the law operates. Rulings are said to be binding on the Commissioner. What that means is that a taxpayer can rely on a tax ruling and the Commissioner can't then apply the law differently to the taxpayer. The legislation that achieves that is on pages 7 and 8 of the handout, and I'm not going to take you there. Taxpayer doesn't therefore have to rely on a ruling if they don't want to, and they don't have to follow a ruling if they don't want to. But they can be confident that if they don't follow a ruling and the Commissioner looks at it, then the Commissioner will disagree with them and will probably impose penalties. So if you don't want to follow a tax ruling, then face the fact that it might end up in litigation. And much as I would like to say as a barrister that litigation is a good thing, it's probably not a good thing for your clients. There's probably not much benefit in disregarding Division 7A deemed dividends. So, to return to the beginning, What you should take away with you today is that if your client is receiving a payment, property, a loan, or even a benefit of debt forgiveness from a private company, then it's most likely going to be assessable as a deemed dividend or as a dividend. And if there's something similar coming out of a trust, then it might be assessable as a dividend depending on whether the company has an unpaid present entitlement in the trust. And to answer whether or not it does, you need to look at the accounts of the trust. And a couple of extra points that I now make as a reward for making it to the end. First of all, if you want a deemed dividend under Division 7A to be frankable and you're dealing with a de facto couple, then make sure that you get an order rather than a financial arrangement. And secondly, if you want the CGT rollover to apply to property being distributed by a company, then make sure that the Section 79 order is specifically for the property to be paid or transferred across, not for a payment to be made. And that's what you need to take away with you this morning.
Thank you, Julianne, for a wonderfully simple analysis of what's obviously an incredibly complex area. It was terrific the way you took us through that, and your papers also are exceptional. So thank you for what's obviously been a great deal of effort put into that presentation. I'm mindful of the time, folks, but does anyone have any questions for Julianne? Yes.
It's not frighteningly obvious, but if you're...
Those comments are always scary because if it's not...
if your client's getting a payment from the company, it's a deemed dividend in a property settlement,
yes,
then the flow-on effect of that is that she pays tax on that dividend
yes,
as income.
yes,
At the normal rate that she would pay income tax on.
that's right. With a franking credit, so long as it's pursuant to a family law obligation, franking credit doesn't have to be, or the dividend doesn't have to be franked, and it's a decision for the directors whether or not the dividend is franked. It may as well be franked. There's a benefit to it being franked because franking credits just sit in a company until they're used. They're not indexed at all, so the sooner they're used, the more beneficial they are. So the directors may as well frank it. So it's best, I would say, to make sure it is franked, particularly if a lot of assets and a lot of cash or property goes out of a company. It's probably going to be some time before it can pay dividends in the future. So those franking credits will sit there even longer.
Right, if there are no other questions, I'll thank you all for your attendance and your obvious interest today in arriving at such an early hour. I'd like to thank also Michael and his colleagues from Green's List for hosting us and for their hospitality. But most importantly, I'd like to thank Peter and Julianne for two wonderful presentations. I know that Julianne is very eager and enthusiastic about entering into the wonderful world of family law, and it strikes me that an obvious advantage of briefing Peter and Julianne is that they've not only got the accounting and taxation expertise from their years in practice as accountants or as taxation advisors, but they've also both worked for the Commissioner of Taxation. They know the legislation backwards and the traps for young players and not so young players alike. So thank you both for your wonderful presentations and the effort that you've put into them.